right, welcome everyone to another episode of Give Me Some Truth International. I'm Sil Michelin, and I'm joined by Keith Pennywise and Stan Farmer today in the booth. And today we're going to talk about currency and really the weakness in the US dollar that we've seen recently is going to be our topic for today. And so, kind of protecting yourself, hedging yourself against dollar weakness, and I would say currency diversification in general is something that we've talked about a lot and wrote about a lot over the years. I think for the most part, nobody really cared because, we were in this era of the strong dollar where, it felt like just the dollar was just strengthening all the time. And if anything, currency diversification would potentially end up hurting you more than anything else. Right. All of that seems to have changed all of a sudden, and now everyone wants to talk about is how to diversify away from the dollar. So let's talk about it now that people are prepared to listen.
Well, we've been banging the same drum for several years now. I think it's important, first of all, what.
Pause. Your mic is not connected anymore for some reason. It looks like it came out. Can you just take that silver part?
Oh, yeah.
Oh, wow. Okay.
No, down.
Yeah, it goes
Right there.
Right there.
Well, it was a really great start. You guys really crushed it.
How many Polish advisors does it take to screw in a microphone wire?
There we go. Yep, got it.
Okay. So, do you want to just finish the top maybe? Or how do you want
Do you want to jump back in on Keith?
Yeah, because you can just edit back in. Yeah.
Okay.
All right, go
Do
ahead,
you
Keith.
remember what we were?
So let me just double check your
Diversification of currency, yeah.
Forgot.
Okay.
It's just...
And whenever you're ready.
Yeah, I think it's important to think about, these issues, but also step back and think about, like, when we talk about diversification of currency, it's really more about diversification of cash flows if needed, right? Because if you're living and working in a foreign country and you're making the local currency, what's going on with the US dollar in a lot of ways isn't going to affect your daily life, right? Other than maybe if you're buying Oreos in London, they'll get a little bit more expensive or less expensive.
Vacationing at Euro Disney.
Yeah. But if you're making money in euros and you're going to Euro Disney, what do you care?
Right.
Yeah.
But it changes a little bit when you're thinking about if you're a retiree in Europe and your primary source of your cash flow is Social Security, a U.S. pension, that sort of thing. So that's, I think, a little bit more what we're talking about. Right?
Absolutely.
And for us, we start to talk about how we diversify investments, right? Because if you're living and working and doing all of that in a non-dollar country, this conversation is a little less, and you don't need to all of a sudden start changing how you're moving assets or so on and so forth.
Right.
And in some senses, it should encourage you to look at making sure you're investing in U.S. markets still, because you're now getting a little bit better price.
Right.
And that's a different change. I think what we're talking about is when you're in this situation as a retiree, how should you handle this? Or, if you're making mostly U.S. dollars, how do you protect yourself? Right.
Exactly. So this idea of currency risk in your financial situation where, maybe you have $1 million securing your retirement and your retirement is in Spain or Germany, right? For example. So all your liabilities are effectively denominated in euros because you're going to spend the rest of your life spending euros, but then you have a lot of your assets denominated in US dollars. And so that presents a risk, right? If the dollar were to fall in value. And one thing that's happened since kind of the beginning of the year, or at least maybe since the middle of February, is we've seen a very sharp move in the value of the dollar. And we've seen the dollar lose a lot of its value against a number of international currencies, including the euro, but also a number of other international currencies.
Yeah, and I mean, this has always been an important part of diversification, is how many dollar-based assets do you own versus how many non-dollar assets do you own? And by that we mean U.S. stocks, U.S. bonds, treasuries, corporates, what have you, and U.S. real estate too, right? Versus non-dollar assets, which some are currency-based, like European stocks that are, reporting their earnings and trading primarily on a European exchange, or British, sterling-based assets, or Japanese yen-based assets, go on and so on and so forth, but also foreign bonds, right? Foreign corporates or foreign sovereign bonds. And many of the investment products of which were U.S. hedged, right? So those would not be non-dollar if they're U.S. dollar hedged.
Right.
But unhedged bond exposure and also non-dollar assets that really are their own currency, like gold. And we could, have a completely different podcast as to whether, cryptocurrencies are non-dollar assets or not. But they could be, right? But certainly gold is traditionally seen as another dollar hedge.
Sure.
Right?
Absolutely.
Well, and you can speak of commodities in that case as well.
Commodities,
And,
sure.
but I think the bigger item here to think about is, first of all, for the previous 10 years, if you've been living in Spain and collecting your Social Security and had your IRA, you are perfectly satisfied if you had just sat in.
Make it 20 years, maybe,
yeah,
right?
Yeah. Sat in U.S. assets, right?
Absolutely.
The problem is, first of all, from an investment standpoint, the time to be preparing for the weakening of the U.S. dollar was when the U.S. dollar was strong. Right?
Absolutely.
And hedging yourself against that risk. But, that means essentially, like insurance, it means taking some future, current earnings and, preventing, future things from where you go.
And that's exactly right. I think, if anything, what's happened since the start of the year is a reminder of why we talk so much about diversification when it comes to your equity allocation, when it comes to your bond allocation, but also when it comes to your currency exposure, right? You can't just assume that what's happened in the last few years is going to continue forever, and the environment can shift, and it can shift very quickly. And, when I opened by saying that people, for the most part, didn't care when we talked about currency diversification before, I mean, this is true. We now get, calls from people who just panic about the value of the dollar. But it's also true that
and just the uncertainty of owning U.S.
and
assets.
the general uncertainty around what's happening with U.S. markets. And it's true that, at the same time, sometimes we talk to investors and we look at their portfolios, and we've talked about this in the past, but it's like, they're 98% S&P 500, and maybe whatever bonds they have are all U.S. Treasuries, right? So, there are ways to build very efficient, very diversified portfolios through U.S. financial institutions that still allow investors to be exposed to different countries.
Yes.
Different currencies, right? And that's an important thing to keep in mind. If there's a simple message here, sometimes people kind of think, they need to get their assets out of the U.S. maybe in order to get diversification and to get non-U.S. dollar exposure, right? That's not true, right? And there are in the work that we do in portfolio construction, our clients will receive their account statement and it's going to show a U.S. dollar balance. But if you look at the underlying exposure within some of the products that we use, they'll be invested in non-U.S. dollar assets. And that's a key part of diversification, is finding those investments that, give you exposure to non-U.S. dollar assets. And it doesn't necessarily mean that you have to go and buy real estate in Spain or in Chile,
or
right?
sell your whole portfolio here in the United States and move it to Banco Santander in Spain.
You can have euro-based assets that are denominated in dollars, and that sounds a little weird for people. So to give a very easy example, okay, And what's going on right now, topically, right? So imagine that you have, two assets. You have the S&P 500 ETF and you have the Euro Stoxx 50 ETF, right? One of them is a euro-based asset, obviously the Euro Stoxx 50 asset. You would have a U.S. registered ETF because you don't want to own a PFIC, passive foreign investment company, and that's denominated in dollars, okay? Because of the stock market effects in Europe and the stock market effects in the U.S., and because of the currency effects in the dollar and the currency effects on the euro, consequently, as the dollar has fallen against the euro, that Euro Stoxx 50 asset, I haven't checked today, but that is a double-digit positive return year to date. Okay, while the S&P might be down about 8%, 7% year to date, right? Part of it is the actual index performance, and part of it is the currency performance.
Right.
They both count together. When translated to dollars, the euro investment has appreciated in dollar terms more than it has appreciated as an index percentage-wise, right?
Absolutely.
Because of this.
So another way to think about it is if you own like a European equity ETF.
Well,
right?
I was going to say, even if let's keep aside ETFs, the way I always looked at it is when I worked at another brokerage, we had the big Bloomberg screen, right? And I was able to pull up Hermes, the leather goods stock. I bought it long ago because I was with a more fashionista girlfriend, and I thought, well, if I buy a share of this, maybe in 20 years I'll be able to afford a Birkin bag. Now I think I can't even get a Birkin bag, but I would sit there daily and I would have it priced in euros, and then I would have the ADR in USD. And on a single day, you might see it go up, 0.5% on the Paris market, but you would see it stay flat on the U.S. market, right? Why was that? Well, it's the currency effect. That same day, the euro lost against the dollar 0.5%. It led to neutral. So, we're seeing the prices in dollars, but the assets that we own are euro assets.
Right, exactly. And that's a great example, and that's exactly also the kind of example I was going to give. If you own European assets and all else equal, the price doesn't move, but maybe the euro appreciates 1% against the dollar, then you're going to benefit from that. And you're going to see that reflected in your account statement in dollar terms, right? So, for listeners who are anxious about the falling value of the US dollar, our simple message is, there are very efficient ways to introduce currency diversification within U.S. portfolios. Again, this is something that is not new to us, something that has been part of our investment practice for years.
One thing I wanted to add to that too is that people are, very anxious right now.
Yeah.
They're worried, oh my God, did I miss the boat? So on and so forth. Right now, as we're speaking, we've seen radical change, but as recently as September or August of last year, we were seeing about a 1.12, valuation of the euro. We're not way out of range, and we've seen differing, so it's not, one, you should have, this is the sort of thing that we've been preparing our clients for, but it's also a case where it's not too late.
No.
The horse is not out of the barn or any other kind of, analogy you want to use. You can still do these things. And, when you look at big picture items, the growth outlook for Europe that we might have seen 6 months ago looks radically different too. And not just because of things happening here in the U.S., but also European responses to their own kind of conditions and situations in terms of foreign policy and so on and so forth.
I agree, and that's a good point in the sense that, sure, we've seen some very sharp moves in currency markets and in the stock market and the bond market, but it's also true that I think if you look at a chart of the U.S. dollar and if you look at like the DXY index, which is just comparing the dollar to a basket of international currencies, including the euro. Well, it kind of peaked in September 2022 around 113, and it's kind of been hovering around 105, 110 ever since, and it touched 100 and even dipped below 100 a couple of times since. I think at least once in 2023, and it touched 100 also, I think, at some point last year. And we are now just dipping back below 100 again. So, if you zoom out just a little bit, we're still within levels that, that we've seen in recent years. And certainly if you, are worried, and if you have a view that there's a risk that the dollar will continue to weaken, I certainly don't think you've missed the boat. And that's an important point.
It's been a good post Great Recession run for U.S. stocks, and the same kind of run for the U.S. dollar, right?
Absolutely.
And the two are related. And when you think about everyone in the world as an investor, the U.S. market has been super attractive because of it, right? Your returns in the S&P last year were phenomenal. But if you were an investor in Paris with a European account and you had S&P shares, your return in euro terms was even better because the dollar was rising. However, that positive feedback loop persisted for a long time. If that long-term trend starts to weaken, it creates a feedback loop. Okay, suddenly the S&P is down precipitously and the dollar is weaker. My negative return in the S&P from my Parisian account is even lower, even worse than it would be if I were an American in dollars, right? And so that could cause assets to exit U.S. investments, which would put further strain on the dollar.
Right.
The same would apply to treasury markets and foreign governments and sovereign wealth funds and so on that own treasuries, right? So when a long term breaks down, a new trend can take its place. And while I don't think any of us are ready to call this the dawn of a long term dollar weakness, we have to acknowledge the possibility of that, right? And so it's never been a more opportune time now. And you're absolutely right. If this is a new trend, this is a very early stage, and it's certainly not too early to diversify.
Yeah.
And we're not suggesting by what I just said about negative feedback loops that this is time to panic yourself out of all U.S. investments. That would be silly, right? We're talking about the time to look at diversification from a greater, larger perspective than maybe you have before.
Yeah, and when I think we talk about panic, it may be, oh my gosh, I shouldn't put money into the market, period. I shouldn't put money into bonds. I shouldn't send money to my U.S. investment account because the dollar is weakening. Actually, that's the sort of a little bit the time to buy the dollar, right? Because I think as well, one thing that gets overlooked is the market is a pricing mechanism. And we're going to see, yesterday the market was down 3%. Today it's up 2%.
Right.
We're going to see big swings as, the market digests information and tries to figure it out. And that holds for the U.S. dollar. That holds for the stock market. That holds for the bond market. And so the important thing is, I think, to develop your kind of underlying principles and hold fast to them, right?
Yes.
Absolutely. And I think currency diversification is really a tool for risk mitigation, right? And this is what ultimately it's all about, is finding ways to mitigate risk and volatility in your portfolio. So all very good points, like Keith said, no panic. Again, incorporating currency diversification should be part of your investment thinking to begin with. And it's true that, like, you and I, Stan, recorded a podcast last year, I think, about home bias in investing, right? And the tendency that investors have, particularly in the US, to invest only in domestic assets, in things that we understand well. And it's true that, you tend to end up with a portfolio that's 98% US. And I think what we've seen so far this year is just a reminder of the value of diversification once again. And if you are in that situation where you feel like maybe you would benefit from having your situation reviewed from the perspective of international diversification, feel free to get in touch with our team, and we'd be happy to start that discussion.
It's a great point. I will just end my final thought on the fact that a lot of people in America think, okay, well, you know what? Foreign stocks and U.S. stocks are positively correlated. They move together. Mm-hmm. That's true, except for the currency component, right? There's the negative correlation.
That's true. That's a big part of it. And
that's why it's a diversification.
That is absolutely part of it. All right, so we've covered quite a bit of ground. So obviously, a lot to cover here, and this is a topic that we'll revisit as things evolve. But for the time being, we'll call it a day. Thank you for listening to this episode.
We did very well there. We didn't say we were right at any point.
We didn't say I told you so, which you were very tempted to say, right? I know. But so thanks everyone for listening, and we'll see you next time.
Like and subscribe.
Be sure to like and subscribe, and we'll see you next time for another episode of Gimme Some Truth International.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.